Why not we go into a classroom for the absolute basics of certain things? The multiples, why insurance, mutual funds, why life insurance, investment, because these are the questions I have been getting. Insurance is always a long-term product. So the investment component brings in the retirement benefits for us, the protection component in the unfortunate event of anything happening to us brings the contingency factor and the protection piece for the family. To start with, since we said that we wanted to be the basics, we don't want to talk about unit link piece right now or the traditional piece. Let's talk about two words, investment and protection. Last time you heard the corporate employees talking about term plans and protection. That is because somewhere in the corporate industry with the online insurance etc. moving up, slight awareness has increased where people talk about being protected and term plans are being spoken of, and there the costs are very low. So what's happening is they are talking about it, but as you saw last time, was anybody covered for the adequate multiples of 20 to 25 times? Nobody was. Are we adequately protected? No. So we are in a situation where again investment bhi pura nahi hua hai, protection bhi pura nahi hua hai. So somebody asked me, multiples, ye multiples kya hota hai? Is it really working? And probably since we just spoke off on the street, some people were not sure of how the multiples work. So maybe I'll just run that piece also down across for you all for your benefit. Last time I gave an example of, let's say your annual income is rupees 2 lakhs for simplicity. Let's say your age is between 25 to 35. So this is the age where you are just started earning money. Your potential increases with age. So as your age goes up, your potential goes up. So as your potential goes up, your annual income keeps going up. So as your annual income keeps growing up, what you need is being protected for that annual income. So your protection amount should go up. With age, potential, with potential annual income, with annual income, the protection amount, the sum assured. This is what we call as the sum assured. So if you are earning 2 lakhs today, that doesn't mean you're going to earn 2 lakhs throughout your life. You're going to keep on growing. So what we say, so up to 25 times cover if you take, that means when your income is 2 lakhs right now, be protected for at least 50 lakhs. So 50 lakhs could be by way of only term plans, only investment, which is not very easy, or a combination of both, which is what I will always advocate. Now this annual income keeps increasing every year. If you are an employee, what's going to happen? You're going to get increments, you're going to get incentives, you're going to get promotions, you may switch over jobs. So your annual income is now going to go up. So every year we grow by age. Every year because of our potentials we get promoted etc. on the job piece. And in business you grow with your clients. As your clients grow, your network grows, you also grow, your net worth increases. So in any case, again with age your annual income keeps growing. So what happens? Let's say now 2 lakhs becomes 5 lakhs. But the problem is, don't forget, you are still at 50 lakhs. So as this moves from 2 to 5, after every 2 or 3 years you need to review it and keep increasing this. So now you're 5, even if you go down to from 25 times, if you go to 20 times, you should be at 1 CR. So the mistake people do is, even if they take insurance at the beginning stage, let's say they are adequately protected, they don't first of all, but even if they take, but as the income grows up, if they don't increase their protection, your family is not adequately protected, because as your income grows, your economic profile grows, your lifestyle changes, your liabilities increase, and the social networking completely changes. So what happens? You are not living in the ambit of 2 lakhs. You grow to the ambit of 5 lakhs. So when you grow to the ambit of 5 lakhs, this 50 lakhs becomes less. What is the best way? The best way I would suggest is always remain protected in a dual manner. One is a term plan, which is pure protection, and second is an investment plan. So in an investment plan, normally you get whatever the premium you pay, you get a multiple of around 10 times cover. That means if you pay 1 lakh premium, the cover which you get is not more than 10 lakhs, 10 or 12 lakhs or whatever, approximately in that range. The reason is, major component of this is used for your investment, right? Whereas in this, it's a pure protection. So if you pay a premium of only 30,000 rupees for a age, you may be surprised, you may get somewhere like 1 to 1.5 to 2 CR, depending on your age. So if your premium is 30,000 rupees, I'm repeating, so you may be surprised to know that you may get a cover of anywhere between 1 CR to 2 CR. So this takes care of adequate protection for you, and now you still have a lot of money left which you may want to use for investment. Now use this for investment. Now the question is, why an insurance policy, why not a mutual fund? I'm fine. But are you going to remain invested in a mutual fund for 30 years? That's the question. If you're going to put money over there and come out of it after 2 years, then your investment component is not likely to be there for you, because equity markets may look very a slanting curve you see, and then there's a fall also. But people who remain invested for long, they always see a very steady growth. And this growth is possible only if you're invested long, not invested short. So an investment plan of an insurance product keeps you into a forced investment for that long period. Of course, you can use the benefits in different ways. There are possibilities to surrender, etc., which I would never recommend. But why surrender? There are loan facilities available. You can use a loan facility. The insurance company can give a loan against that. We can pledge the insurance policies to the banker and get some loans against it. Why go and surrender the policy and lose money? So these are various ways of looking at it, which we'll cover in details when we look at insurance policies in specifics in the future episodes. This program is only for exploring insurance. So we are exploring insurance and telling you. So for a comparison between mutual fund and insurance, in my view, they are apples versus oranges. Are you supposed to compare apples and oranges and say that this is right or this is wrong? Apple is red, to red hai bhai. Orange hai, to orange hai. So you cannot say orange is better than red. Whichever color you like, you can choose, and whichever taste you like, you may choose, because they will always remain uncomparable, and it's a choice which you have to take. And in my personal view, I'll always say go for a combination. If you go for a mutual fund as a combination, of course, you get the growth benefit. If you use insurance, you get protection plus investment. It's always good to be protected and insured and invested in all respects from all points of view. So I think that is what we would like to close with for the investment and the protection piece, the multiples piece, why mutual fund. I believe these questions have been hovering around many times. In fact, I would like to officially get those questions in details, because when the people called me up, some people called me up and said, "Arey, मैंने 4 लाख रुपया डाला है." I would like to bring those questions with more details and talk on those cases specifically in future episodes. Till that time, thank you very much for being with us. Keep exploring insurance with us, and don't forget to subscribe to Ticker TV. Thank you.